let's take a look at the bigger picture. Ann McCabe's with us, CEO and partner at Curo Private Wealth. Thank you for being here. So tell us about what your thoughts are on some of the data that's been coming in. I mean, you've noted it's been pretty positive, right?
Yeah, thanks for having me, Nicole. It's good to see you. So I think the story so far this year has been how the economy and the markets continue to surprise to the upside. And we've seen that in the data that was released this week as well, the economic data. So we saw a massive increase to a revision really to Q1 GDP numbers. We saw weekly jobless claims come in, the lowest level we've seen since May. We got June consumer confidence data, which is the highest we've seen in 18 months. We got new home sales surprise to the upside. And then just this morning, we got the PCE data, which is the Fed's preferred inflation target. And that came in at the lowest level we've seen since April 2021. So despite all the challenges and all the recession talk and defying all the expectations that many of us had for this year, the economy and the markets continue to surprise to the upside. So it's been pretty fascinating to watch so far this year.
So with that and all that's been going on, I mean, what do you say to the folks that say recession ahead?
Yeah, so as bullish as I sound, I should admit that our base case is still that we have a recession. We think we've probably bought some time. It's probably going to happen a little bit later than we originally expected. But the bond market is certainly telling us that we will have a recession. And if you look at what's happening in the regional banking sector, we think that those regional banks will have to shore up their balance sheets and we'll probably see a decline in lending. But the fact of the matter is the Fed can't increase interest rates as much as they have, as quickly as they have, and us not see a recession in our view. We just don't think the full impact has really trickled down to the overall economy quite yet. So unfortunately, we do think we'll have a recession. But I think it's important to remember as investors, we could already have seen the bottom in the stock market. So we need to distinguish the economy from the stock market and make sure that we're not making investing decisions solely based on where we are in the economic cycle.
Right, understood. And you noted in your notes how market breadth was improving. And if, let's say, the bottom we're in, what would you say to folks here? Because I know you don't want to try and time the market. What's your advice to investors?
Yeah, I think your point, Nicole, on breadth is really important. I think this is a story that's not being talked about as much. The story so far, 2023, has been, oh yeah, the top 7 stocks of the S&P 500, which all happen to be tech stocks, are fully responsible for the increase in the S&P 500. And that's not the case anymore. 58% of the S&P 500 companies are up year to date. And if you look at the top 10 performers, yes, they are tech heavy, but we've got some cruise lines in there as well as a home builder, believe it or not. So what we say to investors is we do not believe in timing the market, but we do believe in making investing decisions based on the time horizon of your goals. So we have started to raise cash for clients. We are looking for clients who have short-term cash needs anywhere between 6 months and a year. We are looking to lock in some of those gains. So that could be to satisfy a required minimum distribution that you need to do before the end of the year. It could be for a home improvement project or perhaps an upcoming college tuition payment. So for folks out there, if they have short-term cash needs, we do think that now is probably a good time to lock in some gains, raise some cash. The good news is you can lock in those gains and park your money in a high yield savings or money market, earning 4.5% to 5%, which is not bad at all. So at least you're getting paid to wait. So for short-term cash goals, we think it's probably a good time to take some money off the table. For intermediate to longer term investors, though, our message is to stay diversified in a diversified portfolio and stay invested, because we do think the trend is probably to the upside over the second half of this year.
So yeah, I want to break this down. So for someone who's more short-term, you're saying take some profits, particularly in tech and even the S&P 500, which has had an incredible first half of the year, right, when it's up 15%, let's say. You're taking money off the table, putting it in short-term investments like bonds and things. For medium to longer term, can you just review that one more time? Because you touched on it, but I didn't quite get the takeaway.
Yeah, sure. I think the takeaway is only take money off the table right now if you have short-term cash needs. So if you need money in the next 6 months to a year, we think it's probably a good time to raise some cash. If not, we say stay fully invested. I think it's important to remember that we can't time the market. And also, nobody's crystal ball at the beginning of 2023 was telling us that the S&P was going to be up 15%, right? So despite as much as we study and we review these things, it's impossible to know exactly what the market is going to do. So takeaway for intermediate to long-term investors is stay invested. If we do get a pullback and you have cash to put to work, do that, but stay invested.
And wonderful to speak with you. Thank you so much. Ann McCabe, Curo Private Wealth. Thank you, Ann.